Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the calculation of net credit position. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 821 Net Credit Position tab in the Practice Problems section. Closing this back out, we're going to have our information up top. We'll take a look at all that information, and then we'll have a smaller component of it that we can use to work through the practice problem. So our situation is we're going to be taking a look at the net credit position. When considering our net credit position, we're considering the terms of credit that we are providing, or the credit that we are offering, and the credit that we are receiving. So we're thinking about the two sides, and then we're looking at the average credit and what our net credit position will be between the two of them. The credit that we will typically be providing as a business is when we make sales on account. We make sales on account, meaning we sell and we expect to get money in the future, increasing our accounts receivable. As we do so, we're basically offering the credit to provide what we do, or the inventory we have, to get paid in the future. And then on the payable side, we're talking about our payable, because when we purchase things on account, oftentimes that being inventory, and then we're purchasing something and we're being extended credit at that point in time, we're increasing our accounts payable that will later pay back in the future. Considering our normal, cash management strategy, we would like to be reducing the receivables as much as possible, not by reducing sales, but by collecting on them sooner. And we would like to be, in terms of the payables, we'd be happy to be able to pay later on the payables as well. So this is going to be a measure of basically our credit comparisons in terms of our receivables, our average receivables, and our average payables. Now, here's our information. Average daily credit purchases normally paid in days are going to be 25. The average daily credit purchase amount, so we're saying that we normally purchase, our average daily credit purchases per day are going to be 10,000, meaning on average per day, we purchase 10,000 items on account. And then the average daily credit purchase normally is paid within 25 days. In other words, that's the average payment period that we pay off our accounts payable with. Then we have the average daily credit sales. So we're talking about the sales side. This would be something that we start from picking up on the income statement, look at our credit sales, and then break that down into our daily credit sale, our daily credit sales, meaning these are the sales we make, the revenue side of things, per day on average, 12,000. And then the collection on account, average collection period in days is 30. So this is the average collection period in terms of days for our receivables. So then we want to think about what is the credit position. What if the company adjusts its average payment period to 37? So we'll take a look at the first scenario, and then we'll make an adjustment, and we'll do this again. Here's a smaller component of our information. Now, to do this, we need to figure out what our average receivables are, what our average payables are, because that's what we are extending in credit and what we are getting in credit. And then we'll take the difference between the two to think about what our net credit position is. Now, whenever we're thinking about a situation where we're trying to figure out basically our average receivables and payables, we're talking about items that are on basically the financial statement. So I wouldn't think of trying to figure out a formula simply to figure out the basically average receivable, for example, but instead use the information we have here, which is the fact that we have the 25, or let's take the 30, as the average collection period. So the average collection period is something that we will often calculate on the financials, and it includes accounts receivable. So that is something that we normally look up. Like if you're to look up the calculation for accounts receivable or average accounts receivable, it might be difficult to find because that's something that's kind of on the financials. But if you look up the calculation for average collection period, something we typically calculate on the financial statements, then you'll be able to find that, right? And we can use that to then back in algebraically to the receivable. So this is the formula we'll start with, and then we'll work it the other way, just algebraically. So this formula is the accounts receivable, or average accounts receivable, divided by the average daily sales, which we have been provided with. So let's do that calculation to figure out the average accounts receivable. We're going to say, all right, normally we're going to use the average collection period. I'm going to write it down in like a table format. It would be the accounts receivable. This is the unknown, even though I have a number there. That's why it's yellow. This is what we would not know. And then we have the average daily sales that we would typically have to calculate. Now, they gave us the average daily sales up top, but oftentimes you would only have the yearly sales and on credit. So on the financial statements, you might have sales and then determine how many of those sales are credit sales on account that are going through accounts receivable, and then have to determine the average daily sales on that. So I'm going to back into this number. This is another unknown here. In practice, this would probably be the number that we know in order to then figure out the average daily sales. But I'm going to back into that number just for the fun of it. We don't need it really, but I'm going to back into that. Then the days in the year, we're going to assume a nice even 30-day months. So 30 times 12 is 360. And that would give us then the 12,000. Now this 12,000 is what we were given. We know that number because they gave us the average daily credit sales instead of the yearly sales. So if I wanted to back into the credit sales for the year, the amount that would be on the financial statements, if they're all credit sales, right? Then we can do that. We could say, all right. We could say then this would be X divided by 360 would be the 12,000. And if I was to solve for that, I can say, all right. And then the 12,000 times the 360 would be the 4320. I could double check that by taking the credit sales. This would be the yearly credit sales divided by the 360, which would once again give us 12,000. And then if I know the end number here, which is the average collection period, which is what we would have based on prior data, we know that to be the what did we say? 25. We said it was 30. The 30 average collection period is 30. So then I would back into this number. So this number would be X divided by 12. This would be the formula. X divided by 12,000 equals 30. So then if we back into that, then we'd say, all right, well, that means then that 12,000 times 30 has got to be this number, 360, which we can then double check by doing our normal calculation, which would be 360,000 divided by 12,000, which would then prove that we do indeed get the 30 on down below. Now, if you were to see this, if you were asking someone to give you the answer to this, or, they would give you a formula for the average accounts receivable, and again, you would kind of think you'd need to memorize that, but you don't need to really memorize that. You just use the formula for the average collection period, which you already know or can look up, to back into the receivable. So this would just be working the algebra to do the average accounts receivable. That would be the average daily credit sales, which are 12,000, which were given to us. We don't need to calculate it as we did up top. But if you didn't have it, you'd still need to calculate it because this number is what would be on the financials. And then we would take the average collection period of 30. And then once again, that gives us the 360,000 or 360,000. So that's going to be the average accounts receivable. Then the average accounts payable on the other side of things we're going to be looking into. And so once again, we're looking for the accounts payable. We're not going to like use a formula for accounts payable, or it would be difficult to look one up because that's the number that would be on the financial. What we will use instead is the average payment period. A little less common possibly than the average collection period, but a common formula, that would be the average payable or payables divided by the average daily credit purchases, kind of the inverse of the average collection period. So we know the end result is 25. Let's use the formula to then back into the component we're looking for, accounts payable or average accounts payable. So let's do similar kind of thing. We're going to say, all right, well, the accounts payable is the unknown. That's why it's yellow, even though it has a number in it. And then we take the average daily credit purchases. Now, we were given this number because they gave us the daily purchases. In practice, we may not have it because we might more likely have, the purchases for the whole year, the yearly purchases, and then have to figure out the average daily purchases. So let's do that. Let's do the full thing. If we wanted to look at the credit purchases, this is the number we would more likely have or be able to figure out. But this is the unknown in our example. And then we have the 360 days, assuming 30-month days, 12 times 30, 360, gives us the average daily credit purchases. This is what was given to us, the daily credit purchases on average. If we had that, we can then back into what we think are basically the yearly credit purchases by saying this would be the unknown, X divided by 360 equals 10,000. So we can then say, well, then that 360 times 10,000 is going to be the yearly credit purchases. And I can double check that then by taking the 3,600,000 divided by 360 to get back to the 10,000. And then we know that the total here was given to us at the average payment period, which we would get from prior data. Prior financial statement data would be the 25. So that was the 25 given to us. So we can then figure out the accounts payable up top, which would be X divided by 10,000 equals 25, or 10,000 times 25 equals X, or 250. We can then double check that, taking that 250 divided by 10,000, getting us back to the 25. If you were to see like an example or someone giving you, helping you with this, they would give you the accounts payable formula as if you would need to know the accounts payable formula, but you wouldn't be able to look up an accounts payable formula very easily. You can look up the average payable. So it would look something like this if we just rework the algebra. Average daily credit purchases 10,000. I didn't recalculate it here because we were actually given the 10,000, which in practice we might not always have. We might have this number and have to figure out the 10,000. And then we have the average payment period 25 for once again getting that 250,000 that we saw up top. Once we have that, then we can figure the net, average credit, the net credit position. So we have the average accounts receivable was the 360 that we figured out. That's kind of like the credit that we are offering. And then we have the average accounts payable is the 250, the credit that we're receiving on the purchasing side of things. Means that we have a difference of the 360 minus the 250, or the 110,000 net credit position. Now this is kind of, you can look at this and say, I mean, you can compare this to different industries and whatnot. You could say, well, I'd like to improve this, meaning, the credit that's being offered to us on the accounts payable side is kind of good as long as we're not paying for it, right? We're not getting any fees on this. We would like to increase this number if we could, the credit that's being offered to us when we make purchases, say, of inventory on account. We would like to extend the amount of time it takes for us to pay the payables, because that's typically good cash management. We want to increase our cash flow. And on the receivable side of things, we want to typically decrease this number. Now, we don't want to decrease this number by decreasing sales. Obviously, we want to increase sales, but we would like to then decrease it by collecting on it sooner, so that our net credit position would be leaning more towards the accounts payable being higher, right? So that would be beneficial for us. So we might think about, well, how would we do that? Well, one, we could basically increase our collection periods on the receivables, receiving faster, which would be improving our net credit position. Or we could try to say on the payable side of things, we want to extend when we're going to pay. We're going to hold on to the money and pay at the end of the payment terms, or possibly take on payment terms that are longer with our vendors. So let's assume we did the second one. We increase, what if the company adjusts its average payment period to 37? So before the average payment period was this 25, we're going to say now it's 37. So we're going to have to recalculate then what our average accounts payable is. And then we can take a look at this formula again to see what our adjusted average accounts payable will be. So once again, to do that, we're going to use the average payment period calculation to do that, rather than coming up with a new formula for accounts payable, so that we can back into the accounts payable. So we're going to take the accounts payable, would be the unknown. Then we got the average daily credit purchases, which they gave us, but we're going to basically work it out. It was the 10,000 here, but we're gonna work it out just like we would or might have to do in practice. That would be the credit purchases, the unknown in this case, but what we probably would know in practice, divided by the days in the year. 30-day months would give us times 12, 360, to give us the average credit purchases. This is what was given in the problem, so we could back into this number again by simply saying it would be X divided by 360 equals 10,000, or 10,000 times 360 gives us X, 3,600,000, which we could double check. Taking that number divided by 360 gets us back to the 10,000. And once again, we're given the end number here of the average payment period. Now we're assuming it to be 37. So we're saying, what if we get that to be 37, the average payment period? What then would be the average accounts payable? It would be X divided by 10,000 would equal 37. And then we back into it and say, well, that means that 10,000 times 37, let's do that again. Hold on a second. Something funny happened. 10,000 times 37 would be 370,000 average accounts payable. If I take that and double check it by dividing by 10,000, we're going to get back to the 37. If you were to break the algebra down to calculate the accounts payable, something you won't typically be able to look up. If you're looking up the formula, you will be able to look up this formula to back into accounts payable. It would look something like this. We would simply take the average daily credit purchases, which is 10,000 given to us. In practice, we might need to take the 3,600,000 yearly to get to the average. And then we would have the average payment period, 37. That gives us the 370,000 once again. So what would that do to our net credit position? We'd say, okay, the average receivables are still 360, but now this is now at the 370. And so we have a net credit position, 10,000, and this the company is now the net recipient of the credit of 10,000. This is actually going to be good, right? Because we're receiving more credit, which we're not paying for, right? This is accounts payable. We're not paying any interest on this. We extended the time period that we're going to be paying. And so we're actually being offered more credit with no fee than we are offering on the receivable side. Here we're offering credit. We're doing business or providing something, a service or inventory, without getting anything or having any payment on it until the future. We're offering credit here. We're receiving credit with no interest or anything involved in it. So again, it would be beneficial to have the payable credit increasing as opposed to the receivable. So that would be a good change in terms of the net credit position.